Kalpana, thanks so much for joining us today.
Very welcome.
I want to ask you a little bit about the role of India in the global economic recovery. You're the country head for India, and you head up the Asia-Pacific division for the IMF, the International Monetary Fund. So tell me a little bit about sort of India's role in the global economic recovery as you see it.
Right. Just a quick correction. I'm the Deputy Director of the Asia-Pacific Department, and that covers all countries starting from actually India on the east all the way to Australia and New Zealand and the Pacific India on the west, I should say. India's role in the economic recovery. As you know, India was actually quite badly hit in the immediate aftermath of the crisis, October 2009. And this might surprise people because they think of India as being a fairly closed economy, but actually India is very tightly integrated with the global economy, and particularly through the financial channels. In other words, a lot of India's investment depends on foreign finance, and when the crisis hit initially, that dried up. But India, a couple of things happened. First, I think the policymakers were very nimble in providing stimulus to the economy. Interest rates were cut. A lot of facilities were put in place by the Reserve Bank of India to help credit keep flowing through the economy. And then some measures were also put in place by the Ministry of Finance through the public finances. You have to keep in mind, of course, that India had just come off an election cycle, so there had been already some fiscal stimulus in the pipeline, which turned out to be very timely. Therefore, India's downturn, if you wish, was very short-lived, and has since been contributing very strongly to the global recovery, along with China, which is the other very strongly growing economy. More generally, the Asian region is growing quite strongly, and it is leading, as a region, leading the global recovery.
So you said that there were some stimuli. Do you think that there are that India was affected less or recovered so quickly from the crisis in part due to some of the market controls or any of the financial sector market controls that were in place?
Well, yes. I mean, to some extent, yes, because India, as I said, is integrated with the global economy, but still maintains quite a lot of controls. In particular, the banking system in India did not become involved in any of these activities that, in the end, brought down the banking systems in the U.S. and in Western Europe. And so to that extent, it was completely insulated from the so-called toxic assets that were being held by these other banks in these other countries. And so while there was a general pullback of capital as banks were consolidating through the crisis, once that period was finished, I think funds started to flow back to India. You saw stock markets getting back the funds. You saw the Sensex and the other indices in India going back up. So yes, the controls and the fact that the Indian economy is, especially the financial sector, is still relatively insulated, helped. And then, of course, as I said, the policies that were put in place also helped.
Do you think in spite of that, though, there still needs to be quite a bit of financial sector reform? And if so, can you talk a little bit about
Sure.
what kind of reforms need to be done?
Again, to put things in perspective, India's come a long way. In the early 1990s, there was a slew of financial sector reforms, interest rate deregulation, opening up to the capital markets. And the Indian authorities have a very clear hierarchy in the kind of capital that they want into their country. Equity, foreign direct investment, where somebody comes and actually builds a plant or invests in a plant in India, and then debt. So debt is the lowest, sort of the least desirable, and that's the hierarchy that they follow. They opened up the capital markets to equity, and you have one of the most successful stock markets in India, both from the point of view of returns on assets, but also in its market infrastructure and so on. But that said, there is now a need for major financial sector reforms. And why do I say that? India has, as you may know, and as some of your viewers may know, large needs in infrastructure. These are investments that require large amounts of money. These are not small projects. And typically, they cannot be financed through the banking system. The reason is that most people have their money in the banking system, that so-called liability side. The deposits are 3 months, 1 year, maybe 5 years. Whereas infrastructure projects typically take 5, 10, 15 years to build and then return assets. So what that is referred to in the jargon is an asset liability mismatch. You have an asset of a much longer duration and a liability of a much shorter duration. And that is just not, beyond a point, banks really can't have that on their books. So you need financial markets, you need a corporate bond market, you need debt markets. So while they follow the hierarchy, now the time has come to build debt markets. And debt markets do need, they can be generated through pension funds and insurance funds that exist in India, but you do need foreign funds as well to come in and to generate the market. So that, I think, has to be the next frontier for financial sector reforms in India. This, by the way, is well recognized by the authorities, and steps are being taken to do it. But in my own opinion, I think much more rapid progress has to be made.
So in order to sort of meet its planning targets for infrastructure, what do you see the time frame should be for this kind of thing?
Typically, these markets, they take a lot longer to develop than one imagines. I turn to the example of Malaysia, which was a country, it was affected by the Asian crisis, as you know, in the late 1990s, and it was a very bank-centered economy. And one of the lessons they learned from the crisis that they faced was that they needed to diversify their sources of funding, their markets for funding, and to diversify it away from banks and into different kinds of debt markets. And they made a concerted effort to develop their corporate bond market. It took about 3 or 4 years before they could get it going, and there had to be a fair amount of government intervention. And I don't mean government money. I mean, the government had to become an enabler. It had to get rid of some of the had to put in enabling regulations, had to get rid of some of the impediments. But these kinds of markets do take a while. That's also why we need to have these the reforms done very soon. Just knowing that the gestation period of these reforms is long and the funds are needed now. I mean, we're talking about, actually the ambition was $500 billion of infrastructure investment over the current 5-year plan, which actually ends in a year.
Yes.
So still, I mean, those are all sort of time, slices. Doesn't matter if they meet or don't meet that. They do need to do these reforms for the next phase of infrastructure investment.
You mentioned, some of the lessons learned from some of these other countries. As you look around the Asia-Pacific region, are there other lessons to be learned from different countries that India can kind of, take some, lessons from? And I believe you've written, some people have said it should take a lot of lessons from China, and you've kind of said that may be true, but in a tempered way. So talk a little bit about that.
Obviously, China has had a lot of success, right? I mean, I think it was the Minister of Civil Aviation who spoke this afternoon, who said, in India, people wait until there's such strong demand pressure, and then they take action. Whereas he made the contrast between India and China by saying China, they just build stuff even before they need it. Now, obviously, there are risks to both strategies. The Chinese strategy could be risky because you could be building something that in the end doesn't prove to be very useful. But I think there has to be something of a strategy now, because we've come to the point where India needs to generate large amounts of employment. For employment, you need industry. The service sector, which has grown in India, tends not to be as employment intensive. In general, they need to have industry. For industry to really thrive, for industry to thrive in a way that can absorb this huge amount of workers that are going to come into the labor force, you need infrastructure. So now it's no longer it's going to happen when there's demand. I think there has to be a proactive and concerted strategy. So I suppose the lesson that one can learn from China is that, what are the main impediments that India faces, and how did China, for example, overcome them? You'll hear oftentimes people saying, well, India is a democracy, China is not. Nevertheless, there are some lessons that one can learn. I cited the example of Malaysia, where they made a concerted effort for the government to play an enabling role in generating a corporate bond market. There are lessons that can be learned there as well. So all over the Asia-Pacific region, in the successful countries, Korea is another one which has succeeded in, for example, they went through the demographic transition that India is going through in the 60s and 70s and really capitalized on. They went from being a country that had a lower per capita income than India in the early 60s to where they are now, which is an OECD country.
Indians tend to be very gung-ho about their country's prospects. They're very excited and optimistic, obviously. Do you, at the IMF, see any risk factors that could undermine this sort of success story, this optimism, and if so, what are they?
First, before I go to telling you what might be obstacles, I have to say, in general, I share that optimism. It's very difficult not to be optimistic about India. You have, as I said, we're going to have the youngest labor force in the world for the next 50 years. There is that typically countries that have had that kind of demographic transition have succeeded. You have an extremely vibrant private sector, and we're seeing evidence of that, all over the place today in this conference. A private sector that seems to have excelled despite the government in India. So it is very difficult to be anything but optimistic about India, but there are some constraints and there are some risks. Number one is inclusion. This is a statement that this government has run on. It's won two successive elections based on this platform of inclusiveness. We are going to get to the point where the income gaps are so large that we risk having some kind of really serious social consequences. So this government is completely right in saying we need to pay attention not only to growing the pie, but also making sure that pie is distributed more evenly. But the pie has to grow first. So, there have to be policies put in place to grow the pie. The other risk I see is in India's large fiscal deficits. Mm-hmm. We have deficits that are close to 10% of GDP now. We have a debt of 80% of GDP. We spend significant amounts of the revenue that we collect just servicing the debt. When you have 350 million people living in below the poverty line, that's the size of the U.S. population living below the poverty line. I think I come back to this issue of sort of inclusiveness, but it's if you're not able to provide for your people, and every year you run a deficit of 10% of GDP, which means you're spending 10% of GDP more than you're taking in, sooner or later people are going to say, what's the effect of these deficits that you've been running? So I do see a stability risk from the fact that they have these deficits. Not in the same way, for example, as some of these other countries, Greece or Turkey or some other countries, because India doesn't borrow in foreign currency. Mm-hmm. This has sort of saved it from a violent crisis. But there is a downside. The downside is you're basically eating into your own growth potential.
Right. To dial it back into a sort of a macro perspective, the IMF has been criticized at times for, conditional loans, things like that. We're seeing some pretty interesting things happening in, say, Greece, Spain, etc. What do you think, what kind of global changes need to be made to sort of avoid that kind of thing? Do we need sort of a global consortium, a la what happened in Bretton Woods a long time ago? Do we need some kind of a, global intervention? And what do you see as?
Do we need another Bretton Woods? Probably not. I mean, you remember that the Bretton Woods meetings gave birth to the IMF and the World Bank. So the institutions exist. Right. And the institution, they are, what is unique about the IMF and other organizations, including the World Bank, is we have near universal membership. We have 186. There's no other international organization outside the UN system that has that kind of legitimacy in terms of just coverage of membership. So the institution exists. Conditionality is very much a part of the design of the IMF's lending program. The IMF, as you may know, basically gets its funding from quota subscriptions. So every country that becomes a member is like a membership fee. It's the only money that we have from which we run not only our own operational budgets, but also for lending. And it is basically a fund that has to be paid back in order for us to be able to make loans to other countries when they need them. The conditionality is designed to ensure that we're repaid. That's essentially basic, if I were to boil it down to the barest, simplest terms. Over the years, the design of conditionality has changed. At times, it's been much more intrusive and than it is now. There is a move, and you can check it on the IMF website. There is now a concerted effort and many reforms that have been put in place to make sure that the conditionality that's imposed is really relevant for the problem that we're trying to fix. And not, I think, as it had happened in the past, sort of all the bells and whistles that went along with it. Finally, to your question about what needs to change, the quota subscriptions are determined on the basis of your economic and strength, and it's a formula that depends on a whole bunch of things. Well, the world has changed a lot, and you can say shifted eastward, and the quota subscriptions have to be shifted now to reflect that change in strength. The trouble, of course, is that when you're trying to change a fixed, you're trying to shift quota shares around, somebody wins and somebody loses, and that makes it makes it very difficult to implement. In this case, the countries or group of countries that would tend to be the losers would be the smaller Western European countries. The ones that tend to be the winners are emerging markets in general, but particularly emerging markets in Asia, China being one of them, but others as well. Those governance changes and we call them in the fund quota and voice, have to change, and that is going on. Our managing director has pledged that there will be a reform of these before the end, I think by early 2011, so in a year, and all preparations are being made to that effect.
Thank you so much for joining us today.
Thank you very much.